you very much, Mark, and good afternoon. I hope everyone had a wonderful 4th of July holiday and you're managing to stay cool. Can I ask our three panelists to come ahead and grab their seats up here, and we'll get started with our panel today. Awesome. Well, we're here today to talk about everybody's two favorite subjects, death and taxes. So good night, good to see you. Thank you for being here. Now, we're here to talk about some important sort of federal law changes that are coming, and you might be asking yourself, why are we talking about something that could be happening on January 1st, 2026, just under 18 months from now? And the reason is we want to make sure you have ample information so you can plan accordingly for what might be a very major change in federal law. So just to give you a little background, because I want to reserve most of the time for our really awesome panelists to share their expertise. As some of you may know, in December of 2017, Congress passed what was called the Tax Cuts and Jobs Act. Some people call it the TCJA, I do not. The law took effect on January 1st, 2018, and it is due to expire on January 1, 2026. So again, you might be asking yourself right now, why should I care about this law and its future? Because it impacts the personal and business finances of everybody in this room and clients that you may represent as well. And the more you know about this legislation, these potential legal changes, the better you can plan for that potential expiration. So I'm just going to very quickly give you a snapshot of some of the changes that occurred in the 2017 legislation. And then turn it over to our panelists so they can give us some of their insights as to how this might affect all of us. So, Tax Cuts and Jobs Act, several major categories. There's a bunch of changes in the tax code. If anyone wants to read all of those and the various regulations that came along with that, I'll be happy to find somebody who can send that to you, because I will not be doing that. What I will be sending you after this program today is a really helpful summary prepared by our friends at PNC Bank. We have several members of this organization who are PNC affiliated, and PNC put together a really good summary of the TCJA, and I will be sending that out to everybody. So just a few major categories. One, it changed marginal tax rates. Everybody here is familiar with the concept of tax brackets. So for a couple of those tax brackets, it lowered the marginal tax rate. The top rate, for example, went from 39.6% to 37%. So there's changes in marginal tax rates. An increase in what's called the standard deduction. As you know, when you go to prepare your taxes, you can choose to take the standard deduction or itemize your deductions. The standard deduction went up significantly. For example, for 2024 will be nearly $30,000 for a married couple or a surviving spouse. Eliminated personal exemptions. You might remember that we used to be able to take a personal exemption for ourselves, our spouse, our children. That was eliminated because of the increase in the standard deduction during the 2017 legislation. Further restricted some of the deductions on mortgage interest that had previously been headed in that direction. Reduced the corporate tax rate from what was 35% down to 21%. But, and I think this is particularly applicable to this group of business professionals, those corporate tax changes did not apply to so-called pass-through businesses. So for all of us who have S corporations or have partnerships that are treated as S corporations for tax purposes, that corporate tax rate change didn't affect us because they're pass-through entities. So Congress created something called QBI, Qualified Business Income, so that those pass-through entities could take a deduction that might lower their taxes as well. Linda's going to talk a little more about that today. The bill also doubled the gift and estate tax exclusion and indexed that exclusion to inflation. Rob's going to tell us a little more about that as we're talking. And finally, although this is not comprehensive, there's a lot more in this bill, it created what are called qualified opportunity zones, which allowed investors to people who invested in certain areas to either defer capital gains or eliminate them altogether, depending on how long they held their investment in a particular area where the government was trying to spur economic development. So that is a very short synopsis of the bill. All the accountants in the room are immediately thinking of the 40 or 50 things that I left out of there. That is by design, because we'd be here for several weeks, a seminar on the bill, and we don't unfortunately have that sort of time today. As I said at the outset, the Tax Cuts and Jobs Act is not permanent. Okay, Congress, as it often does, applied a sunset to the legislation. This is a technique that Congress often uses to, I'll just say, manage the fiscal impact of a particular piece of legislation. So the bill was sunset after 8 years. It will expire on January 1, 2026. And we are very fortunate to have three bona fide experts here today to walk us through how these potential changes, how that potential sunset of this legislation might impact our personal and business finances. So let me go in alphabetical order. I'll start with attorney Rob Deaugustinis. Rob is a partner with Ivan and Deaugustinis. He focuses his practice on estate and tax planning for high net worth individuals, real estate, trust administration, wealth preservation, and business succession planning. Obviously, he's a member of the Florida Bar. He's in the tax law section and the real property, probate, and trust law section, otherwise known as the reptile section. Rob graduated from Stetson University and law school from Florida State University. He is a truly excellent attorney. I have the privilege to work with him on a frequent basis. We're really glad to have him here today. Thank you, Rob.
Thank you, Chris.
Also want to introduce our good friend. She needs no introduction because everyone in the room just thanked her during the previous period. But also want to introduce our very good friend Linda Forde, an accountant who is the managing partner of the Forde firm. Again, just a truly extraordinary business professional. Linda is a veteran of the United States Air Force. She helps clients from numerous industries with all of their accounting needs, whether that's tax returns, reviews, compilations to bookkeeping, payroll, sales and use taxes. If it is a tax-related matter, Linda knows how to do it. She's also worked in business in every possible financial situation, whether that's accounts payable, accounts receivable, chief financial officer. So she's really more than an accountant. She's a full-scale business advisor. She's a graduate of Wilmington University, and we're really lucky to have her here today. Thank you so much, Linda. And then our friend Gary Smith is a financial advisor, which he has been since 1981, so now for almost 45 years. He joined What's that? No, but you were 10 when you started, correct? You were a prodigy. That's what you told me. Gary has been with Merrill Lynch since 2007. He's a graduate of both Allegheny College and has a master's degree from Antioch University. He's also a writer, has written numerous articles on financial subjects, including in the past, he had a long-term gig as a financial columnist for the Syracuse Herald Journal, very involved in the community in a variety of different ways, including as a member of Jack's Business Professionals. So Gary, thank you for being part of this today. So I want to start, we described this as death and taxes, how federal law changes impact your legacy and your liability. So I want to start with Rob on the subject of legacy, if we can. So Rob, I mentioned earlier that the Tax Cuts and Jobs Act created some significant changes to what's called the gift and estate tax exclusion. For everyone's benefit here, can you make sure we all understand that concept?
Absolutely, and first I want to say thank you, Chris, for wonderful introductions. I think everyone deserves a hype man like Chris Hand. He's very good at that. So the federal estate gift tax exemptions, they currently are set at $13,610,000 each per person. And that is the amount of money that you can leave at death or give during your lifetime without any estate or gift tax. It's referred to as a unified credit, meaning you can use it during your lifetime or use it at death. So if you give away $10 million during your lifetime, you have $3.6 million left at death. Any assets above that amount are taxed currently at 40%. There's a little bit of a bracket creep up to the first million, but essentially 40% over that, which is a pretty significant tax. One thing that people I think don't realize very often is how much is included in that. I'm surprised when I talk to clients, especially business clients, that are like, the death benefits of my life insurance are included in that. I think some estate planning attorneys in here are thinking of life insurance trusts, so most people who don't have that just think, oh, I was told my life insurance was tax-free, and it's income tax-free, not necessarily estate tax-free. The value of your business, the value of your home, IRAs and other qualified plans are kind of a double hit because you've got deferred taxes in there that estate taxes on top of. And any of your other assets. So pretty much the IRS looks at everything that you own, puts that all together, and then you may or may not owe a tax at that point.
So Rob, how did the 2017 legislation change the treatment of the estate and gift tax exclusion, and how could that change back if the bill expires in 2026 without Congress taking any action?
Sure. So the act in 2017 effectively doubled the exemption from 5 million to 10 million, indexed for inflation, which is how we get some of these ridiculous numbers like the 13.61 million. It's likely to index for inflation. I'm assuming it's going to go up next year. That's what everyone expects. So it'll go up one more year, and then in 2026, assuming no congressional action taken, it will sunset back to 5 million index for inflation going back several years. So best bet at this point is about 7 million or so in 2026. So if you pass away Jan 1 of 2026 or later, most likely going to be subject to the estate tax laws at that time.
Got it. So, I mean, that's if Congress doesn't take action in that regard.
Correct.
That's the gift tax exclusion reducing by more than half of what it would be at that.
Yes, and that would, Congress would have to actually go take action one way or the other to either extend it or to reduce it more. I get asked this question all the time, and it's my opinion that the most likely scenario is it just sunsets, because if you ask me what the easiest thing to do for a politician, that would be nothing. So the easiest thing for them to do, expends no political will, to just let the law sunset. It's still a big exemption. It's going to be about 7 million per person. So in my humble opinion, I think that's the most likely course of action.
So Rob, let's play that out a little bit. Let's assume that Congress doesn't take action and the increase in the estate and gift tax exclusion does expire on January 1, 2026. What advice would you give anybody who wants to review either their personal estate plan or their business succession plan with an eye toward that expiration in January 2026?
Absolutely. There's I could spend hours talking about all the different things that you can do, so I'll try and keep it brief. But I would suggest talking to your advisors, your tax advisors, financial advisors, estate planning attorneys, to see if your estate plan already incorporates some of this planning and if there is an opportunity to do so. I mentioned life insurance earlier, especially for business owners. One of the key considerations when you're going from maybe the high exemptions not having an estate tax to the lower exemptions possibly having an estate tax is, are your heirs going to have to sell the business to pay that tax? The IRS is going to have its hand out 9 months after death saying, I don't care that the business is illiquid, pay me the tax bill. And as an example, if you have say a $10 million estate, right now, no estate tax. 2026, assuming a $7 million exemption, and these are all kind of round numbers, but you're looking at maybe a $1.2 million estate tax. That's a significant hit. One of the areas, and I know there was several life insurance people in the building, they're gonna love this. One of the easiest way to plan for that is with life insurance, preferably in like a life insurance trust that's designed to not add to that tax burden. But what that does is frees up some liquidity for the estate so that they don't have to fire sale the business in a distress sale in order to pay that tax bill. There's other opportunities like portability. If the spouse passes away and they don't use their full exemption, the surviving spouse can claim the unused portion and they would get that portion plus their own credit. There's various opportunities in there, and especially with business owners, I say take a look at your operative agreements. Buy-sell agreements, are they required buyouts at death? How are those funded? Is your estate going to be receiving liquidity from that? It's another opportunity to take another look at things and just to see if there's an opportunity to give some of the business interest now. If it's say a family business or you want to move it down to your heirs, use up that exemption now. There's always a interplay between that and the step up in basis at death. If you pass away owning an asset, the basis gets stepped up, so you'll reduce or eliminate capital gains upon sale. If you gift it away to a child or a trust or something like that, you're generally not going to get that same step up. So the question becomes, what's more likely, capital gains on that, or more concerning capital gains or estate tax on that asset? And that's likely, depending on the size of the estate at that point.
So to all of you life insurance advisors out there, Rob is going to be very disappointed if you don't thank him during the thank you section of the August meeting next month. We're going to segue in just a second to talking about tax liability, because that's also a very important part of the Tax Cuts and Jobs Act's potential expiration. But Linda, let me sort of segue to you a little bit. How are you, in your accounting practice, how are you beginning to see the potential impacts of these changes to the estate and gift tax exclusion?
So for most individuals, there's not a huge impact because, of course, the exemption is so high, 12 million, 13 million. Most people aren't seeing that, and what I would encourage everyone to do is to look at their entire net worth. Small business owners tend to forget that they've got this business and it's worth a lot of money and they're going to potentially sell it when they pass, and they're not including that in what they're looking at in terms of their total estate. So it's very important for the small business owners to remember to include the value of their business. Now, the value of their business and all of the people that help people with exit strategies are going to thank me later. You need to be talking to someone about it. You need to be talking to someone like Cal. There's several of you in the room that do this, because the valuation of your business depends on so much more than just dollars and cents. Are you the primary rainmaker for your business? Is it off of your name alone? Is there someone else that can really truly carry on your business once you're gone in a way that makes sense for the organization? So you have all of that, but then you have to look at QBI going away. You have to look at what your individual, especially because most of the people in the room are probably pass-through entities, you're going to have to look at what does that do to your tax picture individually. And I think for the vast majority of people, that's the real concern. The real concern is what happens to my standard deduction? Are we going to get a personal exemption back? I mean, technically we should if the law sunsets, but we just don't know what that looks like yet. We don't know what that's going to be. Are we going to be able to itemize next year or in 2 years? We might have more people be able to itemize. In theory, we should if the standard deduction goes down. But that's where we need people to be planning and thinking about, so they don't have a huge tax bill come January of 2027 and we start doing tax returns. We need to think about it now rather than just wait.
So Linda, that's a perfect segue to the next segment, which is talking about our tax liabilities and how some of these legal changes, and you just touched on a couple of key subjects. I remember talking to a bunch of accountants when the Tax Cuts and Jobs Act took effect on January 1, or shortly after, took effect on January 1, 2018, and they were now just beginning to navigate this world of having an increased standard deduction and not having personal exemptions and dealing with QBI. There wasn't a lot of guidance on that at the time. Now we're in a situation where almost 8 years later, we might be going back to the situation. What should people in this room today know about those changes to common concepts like the standard deduction, personal exemption, QBI, and what should they be thinking about as we might go back to a world that reverts back to where we were in 2017?
Well, you don't need to run screaming from the room with your hands in the air and your hair on fire. That would be one of the things.
Although if you are, please let Doug Wilder know so we can take a picture.
I think what we need to be doing is planning and thinking about what that future might look like. So you need to be meeting with your financial advice team, your tax attorney, your CPA, your financial advisor, your insurance person, and talking about what that might look like and then making adjustments accordingly. Maybe you have a large house on the river and you've been limited in your real estate taxes. Well, that goes away. So now maybe you have more opportunity to itemize and you want to take more money out of your business. There are a lot of variables at play, so the sooner you start talking about it, the better prepared you're going to be.
Linda, let me sort of follow up on something else, because I mean, I know you represent businesses of all different size, profit, non-profit, but I know you often, because you are a full-blown business advisor, you often think about the entrepreneurial cycle to some extent. If I'm a new business owner, sort of at the beginning of an entrepreneurial cycle, how will these potential tax changes impact the type of business I create for tax purposes, whether that's a C corporation or an S corporation or some other entity?
Well, it affects it significantly. Obviously, you spoke about the corporate tax rate coming way down with the Tax Cuts and Jobs Act. As a C Corp, they're going to go way back up. The only time that small businesses are likely to be a C Corp is if they're using something called a ROBS to finance their business, works really well with franchise type entities, but it may not be appropriate anymore for the financing because the cost of money becomes too high. It's just too expensive to do that. So we may see a change in franchise businesses, and we may see a change in entity selection. Now, it's really important to understand that there's a difference between legal entity selection and tax entity selection. So it's important to have your attorney in the room as well, because that legal protection isn't the same as what we're talking about for the tax side. And as all the CPAs in the room can tell you, there's one form that we can file to make it very easy to be an S corp or not be an S corp. That's the easy part. Making sure you have the legal protections is really probably more important than your entity selection for tax, but you have to talk about it.
Well, now, what advice, so, we've now, hopefully no one is going to run scream and mirror, but hopefully people are going to start thinking ahead. What advice from a tax planning standpoint would you give everybody in the room, knowing that these changes may or may not be coming in early January of 2026?
I really would take the time to get your financial team in the room together. So if that's Rob, Gary, and I, get us in the room together and start talking about what your concerns are. Have that expert advice about what you may need to be looking at. And if you have one of those large estates, if you're potentially going to have estate tax consequences, talk about whether an ILET and an insurance trust might be right for you. Talk about what options are available for you. We're all going to pay taxes. It's just when we pay them and how we pay them, and estate taxes are expensive. At 40%, that's some of the most expensive tax you can pay. So pay the right people to make sure that your assets are titled properly. Make sure that all of your things are buttoned up before we get to that point. Because there's probably not going to be clawback, but there could. You just don't know what Congress is going to do.
We're not due, as Rob suggested, yeah. Gary, let me ask you about this from the financial advisor perspective. So let's fast forward to tomorrow. Everybody in this room has gotten the education the three of y'all are helpfully providing. They've heard about these tax changes. They want to consult their financial advisor, having heard this. What question should they ask, whether that's of you or another financial advisor they're talking to?
Well, first of all, Chris, thanks for inviting me. I appreciate that. And secondly, I want to just tell everybody I'm not giving tax advice or legal advice. However, this is a great opportunity to speak, as Linda and Rob have already mentioned, speak with your other professional advisors. In my practice, I make it a very strong, encouraging point that my clients have estate planning attorneys and CPAs. This kind of advice is invaluable for people. There's so many things that you're so busy doing your career and running your business, you're not thinking about. I tell people that there are three types of risks in the world. Those risks that you're willing to take, those risks that you're not willing to take, and those risks that you don't know you're taking. And one of those risks that you don't know you're taking, and I'm dealing with this right now with a client who is a recent widow, and they moved from Illinois and had a huge successful farm, and they still retain ownership in that farm, and there's going to be estate tax problems and consequences in Illinois. And so I see a lot of people that move down here that have blended families. I see individuals and families and businesses that have property and assets in other states. These are the types of things that you really need to consider. You don't always know, and I tell this to my clients as well, you don't always know what questions to ask. I'll help you do that. Linda and Rob will help you do that. But as time goes on, you're going to wake up some morning and say, what the heck did he say to me yesterday? Call back up and ask us questions. Don't ever be afraid of that. That's what I love doing.
Gary, let me follow up on that, because I know just from having interacted with you, you pay close attention to a lot of these different issues. What sort of resources or tools does your team at Merrill Lynch or the financial advising industry in general use to kind of keep track of some of these potential changes or non-changes that entities like Congress are considering?
So we have a pretty robust investment and resource and investment committee at Merrill Lynch. They are continually monitoring what's going on globally and nationally. They publish their conclusions and recommendations on a regular basis and on a daily basis. There are also other industry sources that do exactly the same thing. So we have a wide variety of recommendations, conclusions that we can call upon, in addition to being able to call people at the home office who are experts in their field, like taxes, like retirement, and so on. And I call on other experts and professionals in this group. But we have a lot of resources that give us that information.
Rob, let me follow up and ask you an additional question. So someone comes in, they hear about this today, they come in, they want to talk about their estate plan as it relates to these potential legal changes. But of course, that's an overall opportunity to talk about estate planning in general. What do you generally advise clients to think about as they are either creating an estate plan or coming in to talk about revisions to their estate plan?
Yeah, I usually have a three-pronged kind of outline when I talk to clients. One is probate avoidance, two is tax planning, three is asset protection when it comes to your estate plan. And there's various levels of each of them that you can do. Probate avoidance is fairly easy to a certain extent with some revocable trusts, but tax planning and asset protection are things that people don't really think about too much before coming in. They're like, yeah, I have a plan, but I don't know what was in it. And, you have outright distributions to the kids. There's ways you can, we're not going to get sidetracked on multi-generational planning in here, but you can do some significant planning for your kids and grandkids via your estate plan. And a lot of times the tax planning portion of that goes hand in hand with the asset protection under Florida law. So you can protect your kids, grandkids from creditors, litigation attorneys, and
Or not about your friends, but
future estate taxes. So there's a lot that can be accomplished, and usually the first thing I ask clients is, what are you looking to do? And then I start hitting them with my regular spiel and start dovetailing that into what they're looking to do. And about half the time they're like, I didn't think about any of this stuff. I need a minute. I'm like, that's fine. Let's have another meeting or let's talk through it. But these are important concepts to think about. And the other half of the time I get what do I hear? I'm dead. Reaction from clients, and I ask them, would you rather your money go to your kids and grandkids or to the IRS? And that's usually a little shot in the arm for the planning discussion.
We have sort of a limited amount of time in these meetings. Do we have a question or two from the audience for Rob, Linda, or Gary? Yes.
So we don't know when they might decide about this being sunsetted. Like they could do it anytime next year or not. They could do it in 2025,
Correct.
2026.
So the law is set to sunset if Congress does nothing. They would have to take action, which we have a presidential election coming up. There might be a transfer of power. Who knows what it's going to look like? But you probably have to get a president aligned with Congress that can pass a tax bill for something to happen. At least in my estimation, I don't see much bipartisanship on this without getting too political into it.
Well, and as you said, they would have up until 11:59 p.m. on December 31st, 2025. And as you know, Congress has taken all that time in the past on various things. Any other questions from the audience today? Well, please give a very warm Jacksonville. We really appreciate each of your time and expertise. I know Mark wants to say thank you.